Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
What's going on there? It's May 1st. I'm Frank Curzio, the Wall Street Unplugged, to make the headlines and tell you what's really moving these markets. So in today's show, is our economy finally breaking down? Earnings season, the winners and the losers. And should we sell in May and go away? Because it feels like maybe we should have sold in April and went away. So that's today's podcast with yesterday's live crypto event. So we record our third installment of our Crypto 2024 series, which was titled After the Halving. The timing couldn't be better as Bitcoin was coming down a ton. But we had a great turnout. Also took a ton of questions, probably an hour and a half of a Q&A. So I love having these things. It's 100% live. You know, we have a new background, everything. I mean, everything could fall on us. Everything's like live. You can see the timestamps, really cool. But I gave my outlook for Bitcoin, which I showed that it's almost inevitable. It's going to go a lot higher. And people might be saying, well, Frank, it's pulling back. It's at 57, now 58. Holy cow, it's 73. It was below 40 when I first told you to buy it, when we first had our first installment. That was about 6 months ago. 3 months ago, when we had our second installment, I was like, buy these altcoins. Our 5 recommendations were up an average of 70% each a month later. And I wanted to have this. We only have these events when you know, we really have something to tell. And with the pullback, you're seeing some great altcoins. A lot of shit coins out there, but you're seeing a lot of great names, even a top 100. Pull back 20, 25%. Right, in the past month or so, providing a great opportunity, but I put math behind it. Simple math, not going to bore the crap out of you in this presentation, of why it's inevitable. I mean, after the halving, and then you have these ETFs coming online, when you actually put the math behind it, which you don't see a lot of people do, and it's very simple math. You're showing how many Bitcoin are now, you know, per day, times that by year, how many going to be minted. Now it's been cut in half after every 4 years, right, which is the halving, and just showing you the demand that's going to come and actually coming. It shows you that Bitcoin is going to go a lot higher. And you're saying, well, it came down. It came down. It's still up 40% on the year. And people talk about gold. Gold is great. It's awesome. It's up 14%, 13% on the year. You're looking at technology up about 4%, S&P 500 up 5%. And this is by far the best performing asset class. So if you're like, well, inflation's going higher and, you know, there's more uncertainty in the markets, deficits are going higher, how come Bitcoin's going lower? Because it got really ahead of itself. You have a greed fear index that was like at 90 something. I mean, if it's above 70, it's high. That's a contrarian indicator showing that, you know, you're due for a pullback, and we're seeing that. But it creates a great opportunity, and that's what you're going to see from us where, you know, we're going to tell you to buy stuff when we see great opportunities. We're not going to tell you to buy stuff when it's at the absolute top, which is the easiest time to sell it, but it's the best way to fuck all your customers. Sometimes our competitors don't care about that. It's all about sales. We do, and people getting in now and buying these, you know, specific names. By the way, I shared a lot of cryptos outside of Bitcoin. I gave you my forecast of when I think it's going to 100,000. And we're talking about, of course, AI, gaming, DeFi, and CeFi. You might be saying CeFi. DeFi is decentralized finance. What do you think CeFi is? CeFi is centralized finance, and there's a massive amount of money going into centralized finance. That was our last recommendation in crypto intelligence, but central finance, think about it. If you have FTX, you have Binance being forced to get out of here, right? They're no longer in the U.S. You look at Celsius, you look at BlockFi, you look at some of the banks. You know, there's few players. There's few players left. And the few players left are going to benefit tremendously now that you have laws that are passed that, you know, you have ETFs that are allowed. We still see the government trying to push back a ton when it comes to Bitcoin. But I think going to election, new administration is going to be a lot different. And you're going to see this is going to be a great area for you to make a lot of money. Might not seem like now. You've seen the economy pull back a little bit. It's a little crazy. But again, if you want to watch that video and watch a replay of it, all you have to do is go to CurzioCrypto.com and you can see it. And it's absolutely for free. I mean, it was live when we did it, 100% live, but you can go and see it, and it's absolutely free to you guys. So definitely, if you own Bitcoin, if you own Ethereum, if you own any cryptos, thinking to own cryptos, definitely watch it. And you can even go back and watch our other events as well. We cover a lot. The questions are great. Sometimes it's simple. How do I open an account? How do I do things to really advance in terms of airdrops and stuff? But we want to educate you on this industry because it's a way to make a lot of money. Again, you're looking at right now saying, well, it's down from 73,000 to 57,000. Again, it was below 40,000. We're telling you to buy Bitcoin, and we have it in our portfolio at 6,000. We have Ethereum in our portfolio at 180. The last time is 18-month period after the halving, which we see Bitcoin go up an average of 600%. we see altcoins outperform Bitcoin by 3-1. They're up almost 2,000% over that time frame. And I actually brought up a picture of our portfolio from the last time at the halving, 18 months after May 20. I think it was May 11, 2020 was the last halving date. And if you look at 18 months and you look at our portfolio, the average position in our portfolio, which I brought up, was up over 600% each position, which is insane. So gains could be made there. Definitely give a listen. It's for free. If not, no worries. But I'm sure a lot of you want to learn more about it, especially what's going on, because it's definitely asset class that people are going to pour into with all the shit going on in the world today, especially Japan and the yen. I don't know if you saw that. Oh my God. I mean, the last time we've saw anything like this with the yen, this is the worst it's been of how it's crashing. But there's like probably 8 periods over the last 20 years, and all 8 of those periods were like, the credit crisis and the Asia financial crisis, all these major events, COVID, the 2022 crash, when you get to these levels. So, they're usually marked by events that are pretty terrible events. And 34 trillion, our deficits are rising $1 trillion every 4 months. We're paying over $1 trillion, 1.1 trillion interest. I'll get to that in a little while. Just that's the annual interest rate on our debt right now. I mean, it's really insane. Anyway, if you want to watch it, go to CurzioCrypto.com, and it's pretty cool and it's for free. Now, let's get into earnings season, which we're in full swing. My favorite part, I won't say of the year, of the quarter, because they report every quarter, but I love listening to conference calls because you learn so much from the management teams and what they're saying. It's not just about their company, what they're saying about different areas, different demographics, geography, and allows someone like me that's been covering the markets for 30 years and knows thousands and thousands and thousands of stocks that I've researched and that I know of who could be beneficiaries based on something that they're saying. And I have to tell you, from listening to these conference calls, and some I listen to, I get transcripts. You can get free transcripts of the conference call, which I advise, if you have these companies in your portfolio, everyone should be looking at it. It'll take you 10 minutes to read them. You can go like Seek and Alpha. A lot of this stuff's for free. If you look 20, 30 years ago, when my dad was in business, it was only analysts that were able to get on these calls. You didn't even know what was going on. And if you wanted to research, there was no computers. You had to go to the library. You had to find stuff in encyclopedias and stuff. You had to make phone calls. You had to go meet management teams. Now you all have access to this. Take advantage of it, because it's or a service that actually will give you bullets, like a briefing.com or whatever. I don't have a deal with briefing.com, but I use that. It's a great site that just gives me bullets for conference calls. And sometimes I'll see something. I'll say, wow, I want to read the whole transcript of that call. But anyway, we're about 50% into earnings, right? 50% of companies reported earnings, the S&P 500, and holy shit, the commentary coming from management, and this is from the conference calls, has not been this dreary and this scary since 2020 March, which was like a month or two before, we decided to spend trillions and reopen the economy at the same time. But the commentary is horrible. And it's a lot different from what you hear out there. Well, the economy is good and job market's good. Man, I mean, did you see Starbucks? Starbucks has a China focus for growth, and almost every company that has that focus, Yum Brands did okay with the quarter, but their estimates, were okay, but they were lowered, right? Nike, not too good. You're seeing just companies. It's just an indication that a lot of people are jumping on China. I'm going to talk about this tomorrow. I have a great interview with Andrew Horowitz. He likes China right now. I'm still skeptical, but we have a good debate. And that's going to be Wall Street Unplugged Premium tomorrow, which is awesome. But if you listen to Starbucks, they lowered the bar tremendously. Starbucks lowered the bar tremendously. It was a number that they couldn't miss. I mean, it's rare where you see the whole world piling on a company and it's worse than what everybody believes. It's very rare, right? We started with Tesla. The whole world piling on them. They report decent results and the stock surges. And then, of course, the China news, and the stock was up 35, 40% in a week, because it was down 45% going into that call. It was down tremendously. So Starbucks was so bad. Okay, it's down 12%, 13%, large decline in a decade. The numbers were significantly lowered into the print, and they didn't beat them. But they missed by a mile. Also lowered guidance from 15 to 20% growth this year. Remember, we're supposed to see massive growth in the second half of this year because of lower interest rates. And that's off the table. We're supposed to be 20% earnings growth this year. I have no idea how we're going to make it there. Unless the 7 or 8 large companies really take up like 60, 70% of that, which is possible. But just to put in perspective, they lowered their guidance from expecting 15 to 20% growth this year to no growth at all. Not to single digits, low single digits, to no growth. The CEO, this is some of the commentary. Fiscal Q2 traffic was down 7%, the weakest in 20 years outside of COVID. China's still horrible. April did not end well, which means the start of next quarter is already bad. That's why they lower guidance. So, it's when they're reporting, if you don't know this, when they're reporting numbers now, they closed the books over 2 weeks ago, 3 weeks ago. So the first 3 weeks is going into the next quarter. So they have an indication if those 3 weeks are good. It's a good time period, right? 3 weeks, it's big, probably 25% of the quarter that they'll look at and they'll say, well, we're seeing strong business and it might lead to them, maintaining their estimates for next quarter, raising their estimates. But they just said like the quarter ended and it's already off. The next quarter's already off to a bad start. They said their occasional customer, they call them occasional customer. That's another way of saying your best paying customers are also cutting back on spending. If you look at Starbucks as a stock, still trading 18, 20 times forward earnings. It's based on 2025 estimates. They're reporting 2024. 2025 estimates is their forward earnings. They're expecting $4. They're not even come close to that, even though they maintained it. They maintained $4. I have no idea how they're going to come close to that. The stock was 105 in November. It's now trading at 75, but this is more like a $50 stock if you believe earnings for 2025 are going to come down significantly, more like $3.25, which I think. Now they see the risk ahead of them. They saw the risk ahead of them for the last year and they haven't adjusted. So they're going to cut costs, kind of like Disney. Disney's went up 12% and it's not a growth story, right? They're still losing money on streaming. They beat estimates that was significantly lowered. It's a cost cutting story for Disney, right? That's why they reinstated a dividend, which I think is going to be a big mistake. But it's not a growth story. So let's see if they can cut costs to the point where if they just maintain and see, just growth not as bad, maybe we could be okay, but we talk about expensive stock and we talk about that across the board, right? There's a lot of expensive stocks that have growth multiples that are not growing. They're not growing. I mean, you want to talk about risk? Holy shit. I mean, look at Norwegian. Norwegian reported earnings, had their record backlog, record business going forward in just forward business of people paying that they raised their guidance and the stock got hit. It's down 10%, 11%. Because they thought it was supposed to go higher, and that's not really expensive stock. I think it's an incredible buying opportunity in Norwegian. I think it's a great company. Plus, what we hear from Comcast. Comcast was a disaster. They, just everything involving in Comcast business. So if it's streaming, if it's just linear TV, but more importantly, they said they saw a significant pullback in park attendance. When have we heard that? When have parks pull back? I mean, it's always strong. And they said, lower traffic is due to increased competition from what? From cruises. Because it's cheaper to go on a cruise, much, much cheaper than going to Disney World or going to Universal parks and going to Disney. You're going to Orlando or going to California to these parks. And they said lower traffic, Comcast, is due to increased competition, again, from cruises. But it's a problem I don't see going away. Because you already raised prices significantly at the parks. I'm throwing Disney in there already, right? So where are you going to get these returns? Where are you going to see that? Is it more cost cutting? Maybe. But I'm interested to see what Disney reports because that's been their bread and butter, their parks. I've been arguing they should just open up parks and get out of streaming. You see what's happening to Paramount. What a joke. What a joke Paramount is. Yeah, Redstone, she controls the controlling shares. They're trying to fuck all the investors on it, all the regular investors. Class A, Class B. She owns Class A. She is has basically all the votes. Apollo came out with an offer. They should have ran. They should have took the offer and ran and wanted to buy the whole company. Instead, now they're going to sell certain pieces. She's going to get a $2 billion paycheck. That's why she wants to go with Skydance, who's was it David Ellison, Larry Ellison, Oracle's son. But they're not allowing votes, and you're seeing Class B shareholders like Gamco, who's Mara Gabelli and others saying this is the worst. We don't want this deal at all. It's horrible. They're basically taking their streaming assets, the shitty assets they're losing billions on, and they're going to give it to the shareholders. But they have amazing, amazing assets, right? It's a good business with their assets. They have Tom Cruise, Mission Impossible, MTV. They got unbelievable assets in there, but it's just streaming that's destroying all these companies outside of Netflix, and they don't know what to do. So now they're construction deals. It's so amazing. But when I look at Comcast in there, and whether it's Peacock, whether it's HBO, I think is good. They're doing a good job in terms of new content. We talked about this, how streaming is the worst business in the world. I've been seeing it for 4 or 5 years. Netflix is the only one that gets it right. HBO's okay at it. Hulu's been around the longest, 15, 17 years. They still haven't made money. They don't report the financials anymore. And now Disney was forced to buy that at a sick premium. And if you want to know how sick it is, and people are like, well, how do you know it's a premium? Because no one else fucking bid for those assets. No one else bid. They could have other bidders. They didn't. They locked them in for a minimum bid price of whatever it is, $9 billion Comcast, which is great. At least they saw that check. But I'm interested to see with Disney, where streaming is not working, how much more can you cut costs? Because you cut them tremendously before you see, service deteriorate. And now, Park's not doing as well. Let's see if that filters over to Disney. Maybe it didn't. But Disney went from a low expectation stock. I told you they're going to beat the numbers. Stock's going to go up last quarter, to a very high expectation name, right? You got guys on the sideline that you rejected on the board and said, hey, we don't want pelts or anything. It's going to be interesting to see what Disney reports going forward, because, based on Comcast and the Parks and the weakness of what they're reporting, there's not a lot more cost cutting you could do. It's going to be interesting. And their streaming business is just horrible. Like, they don't have any new content coming out. It's just a real waste. I know they're trying to do different things. Even ESPN is seeing declines and stuff like that. It's just, it's so costly and so hard to maintain. Just do what Sony did. Sony signed a 4-year deal and making, probably getting $1 billion for 6 months after they release movies. They go on Netflix platform. And after that, Disney signed a deal with them for, I think, 2028 and on. Why wouldn't Disney do that? You have all these platforms looking for content. Come on, guys. They're all dying for content. Why run your own platform? And not only does your platform suck outside of Netflix, and your platform really sucks, what are you going to do? What's going to be the user experience? We're going to throw ads all over this shit, and then we're going to raise the prices on you. Really? You really think that's going to work? Good luck. You can still cut it. You still have great content for Disney. Same with Comcast. But, if you're going to have your own streaming site, man, you just can't compete with Netflix. It's Netflix and everybody else. McDonald's. Same thing when it comes to commentary. It's horrible. It said traffic in U.S. is declining. Consumers are very conscious on how they're spending now. But one thing they said that past couple of quarters, but they said the pullback in spending, while more pronounced with low-income consumers, they're seeing the pullbacks in spending from all the demographics now. From everybody that goes there. Middle income, higher, whoever likes McDonald's, they're seeing those prices, they're seeing the pullback. We're not seeing the jobs, not seeing certain economic data, but the companies are saying this, and there's a reason why you're seeing massive amount of layoffs. You think the unemployment rate's going high, but it's not, because you're seeing a lot in services, and you're seeing people who have jobs get a second job. But people with full-time jobs, if you're looking year over year, that number's down in employment. People don't talk about that when you really break out the numbers. I'm not cherry-picking companies here. Trucking companies, J.B. Hunt, Swift Knight. These Knight Swift, reported numbers that were absolutely horrible. And this goes for the past 2 quarters. I follow these companies. And they said business has been really bad, really terrible, but it's going to, just like everyone else, it's going to get great the second half of the year. Why? Because everybody thinks interest rates are going to go lower. Everybody thought that in October, January, February. And now we're realizing that they're probably not going to go lower. We're seeing inflation pick up. So they reported horrible numbers again. And the commentary is important. You can report horrible numbers and say, look, it was bad. That's the core. It's a kitchen sink, kind of like what Snap did. And then reported, blockbuster results across the board. Results, probably one of the best quarters with Snap that so far that I've seen this earnings season. Unbelievable quarter for Snap. And I'm just surprised that it went down so much after the quarter before. I didn't think it was that bad. But, man, AI products, selling AI products, that enhance these pictures and charging, whatever, $3, $5 a month, and people are paying for just starting, just a whole new revenue stream business, and advertisers on fire. They're doing great. But when it comes to these trucking companies and you're listening to what's going on under the hood, you determine that but by listening to the commentary on the calls. They're giving you a real perspective in real time. And I got to tell you, these guys, they said not just slower traffic again, but shipping companies are raising prices. So the shipping companies, right, they get all the goods from ships, and now you have these trucking companies. The trucking companies bid. They have a bid season. And he said the prices have gone up tremendously. So if they want to have that business, they have to bid higher. What does that mean? It means slower demand, which they're talking about, lower traffic, coupled with higher prices, higher costs. That means that your margins are going to get annihilated. Okay? It's not just like, hey, slower demand, we may have a lower price. They're paying higher costs at the same time when demand's waning. And that's why I say the reverse of that. When companies cut costs, say like a Disney, when Disney cuts costs, and then you see business start turning around and you have much less costs, especially when you're laying off employees, which is the worst thing for employees. But when it comes to businesses, right, you're cutting your expenses, and then all of a sudden you're seeing your business turn around and grow. You get like this, this big shot of steroids. It's not just a cutting costs where, okay, this is going directly to my bottom line and saving money, but now your business starts turning up and you see earnings explode. And you see that. If you can determine to get ahead of that, man, stocks sometimes double off their lows immediately, and then they'll just start going higher and higher, especially small caps. When you have the trucking company saying that It's the opposite. Slower demand coupled with higher costs. Usually slower demand leads to lower costs, right? Because there's little demand, so we're going to lower costs. It's higher cost, slower demand, which we're seeing across the economy right now. And that's a double-edged sword. Cisco, the Cisco that begins with an S, not a C, the food distributor. Lower traffic in restaurants. February and March improved a little, but traffic's still down. And keep going here. Skyworks, you see that quarter? They're down. They're getting nailed today. 66% of Skyworks revenue comes from Apple. And here's what they said. Significantly lower guidance. Earnings per shares were projected at $1.46. They lowered to $1.21. That's a big, big lower. Expects, they say further modest growth. So, basically to continue weakness. But stock's getting nailed today, despite, trying to cover it up, declaring a nice cash dividend. It's still getting hit, but 66% of their revenue comes from Apple. So what is that going to say? We know a lot of the risks that are in Apple. We just recently recommended. I think that June event for Apple is going to mark a bottom in the stock when they really go over the AI strategy at the developers event. I think it's going to be one of their biggest events since the launch of their first iPhone. I think it's a good time to buy. You might want to wait till after the quarter. The numbers are bad. Everyone's expecting the numbers to be bad, but let's see what Apple reports. Apple does have pricing power, and Apple does have cloud. What we saw, okay, because not everything was bad. What we saw with cloud, okay, and I'm going to go back to CVS in a minute, which is horrible. But what we saw with cloud, think about Amazon. Amazon reported. I thought the numbers are fantastic. And I love when people are worried about, higher spending, especially when it comes to Meta and Amazon. Because one of the most certain trades in the world over the past 15 years have been buying Amazon when it declines. When you're seeing the stock decline because they have higher CapEx concerns. Or that's what investors are concerned with. But they'll have higher CapEx and higher spending. Amazon, I'll throw Meta in there too. Amazon, time after time after time after time, has proven as the best return on investment capital ever. Okay, you spend more money to provide better cloud services. Check, they did that. Right, spend more money to provide better logistics for one-day shipping. Check, got hit because they're spending more money. One-day shipping. No one else really has one-day shipping, right? And they got much better. At the beginning, it wasn't really one day. We all know that. It's one day, believe me, because I go to my house and there's like 6 boxes on the freaking step for my wife all the time, which is cool. She's not just buying, okay, she's not materialistic at buying crap, but stuff for the house. We just have it automated, whether it's, if it's tissues, if it's towels, if it's dog food, cat food, right? Automated. It's just, but constantly, like the one-day service, it kicks in, right? They plan on spending more money on AI now. And people are like, oh, well, that's going to be a negative. Really? Really? It's going to be a negative? Because you're looking at the greatest retailer the world has ever seen that's been tracking close to 230 million U.S. customers, 310 global, 230 million U.S. customers for over 2 decades, right? Who receives close to 3 billion unique users on their site every month. And if you're looking at cloud for Amazon, it's absolutely surging. This is supposed to be a mature business. Why is cloud surging? Because a lot of people are arguing. I argued this because in tomorrow's interview also, it's going to be cool with Andrew. And we have a little back and forth about AI. And he's like, even Zuckerberg said it's going to take a while. He has to say that. He has to say it's going to take a while to develop, guys. He has to say that. Because he can't say, well, AI, we're tracking everyone and we know exactly what you're going to do now. 50% of the content on Instagram is AI generated. Okay, when you're looking at cloud, look at Amazon report cloud. You're seeing the percentage of growth, right? You're still seeing growth. It's mostly cloud should be a mature business. It's been around forever, right? You have the industry leaders, right? If it's Amazon, if it's Microsoft Azure, you have Google Cloud as well, Oracle you could throw in there, right? And Apple and Amazon. Look at the cloud growth that all these companies reported this quarter. Microsoft blew out the numbers. Amazon blew out the numbers. Google, you want to know why it went up? It's because they blew out the numbers in cloud. The reason why cloud's going up on a percentage basis, I mean, it's going up on an actual number, right? But the percentage, you're supposed to see slower growth. And the growth's starting to accelerate again because of AI. Everybody's paying for AI. If you want proof, look at NVIDIA's numbers. I mean, this is a company that's generating $5 a share. They're generating $23, $24 a share now in earnings. Massive growth, massive revenue generation. So you're seeing all these companies and everyone going into AI, and they're seeing the benefits tremendously through cloud, which is why I like AI so much, because these companies don't have an AI division. People looking at Microsoft Copilot. It's not the Copilot that's going to do great for them. And again, that's just, let me be able to charge a little bit more for Microsoft Office products. This is about cloud. This is about inference. This is about, throwing this into your CRM services. All of this goes through the cloud. And when you have the cloud, it's a massive high margin business. There's a reason why the biggest companies in the world, the reason why those went so much higher after earnings and did very, very well, is because of their cloud. And again, this is their high margin business. This isn't like a retail business where you got to buy a product for $30 and sell it for $35. This is like pure margins. I mean, the scalability of cloud is unbelievable. And now you're throwing AI into it, and these features are working. And obviously, they're building it. They're building these systems and continue. You could see from NVIDIA sales, and you're seeing it not from AMD sales. I think, listen, when I had our live events for AI, when we just launched our Curzio AI newsletter, I told you names to avoid, and AMD was one of them. It's not an AI play. Okay, they have a certain section of AI. They're not NVIDIA. They're not even close to NVIDIA. NVIDIA's been building this for 15 years. They have other shitty divisions that are horrible, and AMD should never, ever, ever be trading at right now. Still, it's down today. It's getting wrecked on earnings. It's still right now trading at a 25% premium if you're looking at forward earnings to NVIDIA, which is a joke. Okay, I mean, we've been saying this is a stock to avoid at 190, 180, 170. I don't even know what it is today, 140s. I think it briefly went over 200. People keep pitching AMD like an AI play. It's not an AI play. It's not an AI play. They're not even close. They're not even close. They might make a chip or two, whatever, but still, it's the whole ecosystem. NVIDIA is not even like a hardware company. It's more like a software company. And you're seeing that get nailed. So the point of this is when I'm looking at is AI doing good? You're looking at Apple. Apple's cloud division, they haven't even begun to use AI. And now they're releasing its technology, stuff that I follow. It's amazing what they are doing in AI right now. They're going all in AI. By the way, what is it? $100 billion on the balance sheet. They could buy almost anything they want other than the big technology companies. But you probably see Apple decline. That's the last major company that's yet to report for the quarter. Maybe, I mean, everyone's expecting horrible results. We saw what happened with Tesla when you're expecting, when all expectations are really bad and everyone lowered their numbers into the quarter. Skyworks is kind of, with most of their business in Apple and those guys warning, it tells you that the Apple core is probably going to be a little bit weaker than expected. I think it's a great buying opportunity because the AI component and the cloud component, which once you're on a cloud service, it's almost impossible to switch unless you want to stop and rebuild everything from scratch. If you don't think so, try going from a Samsung phone to an Apple phone and try transferring all your data over. Good luck. Good luck. Not easy, or vice versa, right? So once you're on it, it has all your pictures, it has everything in the cloud. Now you're going to throw AI on it. Not to mention, we all talk about pictures and videos. I mean, you're looking at the iPhone is a professional camera. I mean, it takes better pictures than $500, $700, $8,000 cameras right now, and especially the two latest versions. I mean, all this and putting AI into it and what you're capable of doing. Apple's going to be one of the best players, one of the biggest beneficiaries. They were late to the party. They know it. They're spending a lot of money. But I think in June, you're going to see, one of the most important developer conferences when Apple's really going to surge. But you might have to be a little worried into the core. But not everything was bad, right? So Microsoft, good. Google, most of them that have cloud services were good. And I just want to cover CVS before I go here. Horrible numbers / guidance. They blamed on higher medical costs for their insurance business. But guidance for 2024 was cut from $8.30 to $7. I remember when Walgreens and CVS, Walgreens, horrible. You saw that stock, crashing as well. It dominated the pharmacy industry, Rite Aid. Remember? If you're looking at what they actually do, these companies, every supermarket offers these services for pharmacy. Walmart, Target, even Amazon, right? You can get your prescriptions through these companies now. You can even go directly to the companies for weight loss. You can go directly to Eli Lilly to get your weight loss drug now and save instead of doing all this, going to Walgreens, CVS's. So that leaves their retail business, and they can't charge 2 to 3 times more for every single item in their store. And they'll never, ever do price matching ever. But you go in that store and everything is just like a freaking fortune. It's a fortune. It's marked up tremendously, especially when there's when you see what these things are built, there's probably a Walmart or Target within a half a mile from where it is. And people are like, I'm not going to CVS no more. I mean, same thing with dollar stores. It's a dollar store, but when you're raising prices well over $1, well, now you're competing with Walmart, where I could buy 80 things if I want, instead of the 2 things I'm looking to save money on that you have at a dollar store. It's the reason why dollar stores are doing shitty. But what's the necessity for the Walgreens and CVS's anymore? It used to be huge necessities. Now, what's the necessity? What's their purpose? I don't see it. I really don't see it. So just that whole industry in terms of not the industry, but those two companies particularly, I just can't see it getting any better. Maybe I'm wrong on that. We'll see. Overall earnings have met estimates. The guidance has been okay, but the commentary and for these companies, for the massive growth we're expected to see in overall earnings in 2024 in the back half of this year on lower interest rates. We know interest rates going to stay higher for longer. The caution and what I'm seeing, the commentary from these calls have never been this negative before. They're seeing it firsthand with consumers. You might not be seeing it. You're feeling it. A lot of you feeling it. But if you're listening and you're hearing things on TV, the economy's great, unemployment's awesome. I mean, look, 45% left of the S&P 500, about 55% reported. So we still get about midway through, and we got over 1,000 small mid-cap companies going to report. It's going to be interesting what we hear there. But it's not just the earnings that are making headlines, guys. I mean, economic data has been pretty bad for a Fed that's expecting inflation to come down. I mean, forget the CPI, PPI, the PCE, inflator, all that stuff, which was higher than expected. And this is the past couple of days. The Q1 employment cost index, much, much, much hotter than expected, 1.2% quarter over quarter. The consensus was 0.9%. That's a big miss. Year over year was at 4.2%. What happened to 2%? 4.2%. Again, employment cost index. April Chicago PMI came in at 37.9. They're expecting 45. Worst reading since November 2022. Case-Shiller house price index, stronger than forecast. Prices are remaining high. While ADP jobs data also strong. So, you want to see weakness across the board because that makes sense for the Fed to cut. But when you see unemployment strong, we had, ADP data was good. We'll see what Friday brings with the unemployment report. Housing is staying up there, even though it's kind of like a frozen market. It's very difficult with rates this high and people don't want to sell their mortgage or sell, they have a mortgage at under 4%, probably under 3.5%. They're going to buy another house. Probably it's going to be much, much more expensive. Or maybe, it's in line with the price that you're selling, but you're going to be paying a shit more because mortgage rates are over 7% for the 30-year mortgage rate. But what's the Fed going to do? I mean, they can't cut. I mean, inflation's way higher than it was in December and January. You didn't cut when you decided to pivot a little bit and then take it back. You can't raise. I don't see raising because it would crush consumers, especially low-income consumers. It's going to crush them even more. We saw Visa say that business is okay. And then we saw MasterCard come out today, which went up, and now it's coming down. But they said, the economy's fine. I don't want MasterCard's numbers to go higher. It's not an indication that the economy's fine. It indicates that people can't tap money at the house. They're not making as much money. Bills are so high that they're turning to credit cards at 27% interest rate. That's not an indication of more people spending on credit cards. It's not an indication that the economy is strong. Now we have 27% that you got to pay annual interest. Are you crazy? So it's just funny when I hear those reports. But, we're at a market where the Fed can't really cut. They can't raise. Politicians won't stop spending, even though we're at full employment. And what does that mean? What does that mean when I say that? Because when you're looking at the amount of spending that's taking place from our government, that usually takes place to stimulate the economy. That happens when we have an unemployment at 7-8%. Maybe we're going into a recession and you want to stimulate the economy. And then when you stimulate the economy, you throw all this money into it from the government, and then they make it up on the back end. More people get jobs. The economy starts picking up. You have lower rates. And now you have more tax receipts from these people that have jobs. We have full employment. And they can't make ends meet. They can't make up the difference in spending, right? Because most of the people have jobs already. But when you're seeing the spending that's taking place at this level, when we're at full employment, what happens when growth slows, which we're finally starting to see? What happens when this growth slows, but prices remain elevated, which we're actually seeing? So it's going to lead to higher rates for longer, higher payments by our government to fund this debt, which is at $1.1 trillion in interest payments, annual interest payments. So if the debt stays the same, $1.1 trillion, how could that be sustained? Our debt is surging, increasing by $1 trillion every 4 months right now, and it's leading to the Treasury having to borrow more money to pay the bills, which we just saw 2 days ago. Right? It was like $200 billion. They had to go to $243 billion. They had to borrow even more. And they said it was due to weaker cash receipts, which is taxes from consumers. So if that's weak now, as the economy gets slower, more people, companies are going to start laying off even more. Where are you going to get the taxes from? Where are you going to get the receipts from? This is where we are. I mean, it means the Fed loses the power to help the economy, which they always had this power and they have unlimited sources. They just painted themselves into a corner here. But it's going to be an interesting year, especially because people are quick to say, well, Frank, it's an election year, so no matter what, and I get it, right? It's the current administration, any administration that's in office during election year is going to spend like crazy, right? Because they want to win. It's in their best interest, right? It's going to lead to a lot more spending. Just send more money to Ukraine. Okay, we just did. And not because they care about Ukraine. It's just, okay, we know based on a poll that we're going to get a certain amount of votes if we do this. They just forgave more student loan debt for like art students and stuff. My daughter's probably going to go away for art. I know the numbers in art, but she did win. She's up for a massive award, which is going to be good in terms of getting a scholarship. And I wanted to follow her dreams. People are like, oh, don't tell them to follow your dreams. They're not going to she's going to be fine. She's smart. She can get into my business. She can do anything she wants. But she's very, very talented. It's not like, oh, I painted pictures pretty. I mean, she's basically in a running, I think 5 people in the state of Florida for an art piece. And hers is the only one that was a sculpture. Everything else was a picture. And I saw the other ones and I thought, and I'm 100% biased here, but that was the best thing I've ever seen in my life. It was really nice. It was really nice compared to the pictures. And then it goes national event, and that's the process now. And she's just another great piece. But, I wish she was in school. I wish she was in college right now because all the debt got forgiven. And this isn't about helping students. It's about getting votes, right? That's what this is about. Keeping energy prices low by not replacing the SPR like you promised for the last 18 months. Oh, we're not going to do it now. Prices are higher. Well, prices are now below 80. Are you going to buy? No, they're not. Of course they're not. Absolutely not. They want to keep prices low as possible. They don't want to buy oil here. Even though what? It's 60, 70% lower, the SPR than it was. When Biden took office, and it's not, this isn't Biden. This is any single president. I mean, you look at Trump as well, 2018. He's like, telling the Fed, you're lowering rates, right? It's 2017 going to 2018. The path that we're on is unsustainable, guys. It's unsustainable. And tomorrow in Wall Street Unplugged Premium, again, going to break down these trends in detail. Andrew Horowitz, I'm going to be interviewing him a lot. I love him. Great guy, Dismal Investor podcast and stuff. We're also going to share lots of actionable ideas with you, including how to hedge yourself. Andrew is short 15% of his growth portfolio, hedging himself. So, which is, I think he says highest amount in a very long time, but he'll break down, how he's doing this. Okay. Sometimes what we say, well, buying puts is a strategy. Buying puts is very, very difficult. It depends on the pricing. And sometimes you could be right and still, not make money. It's not the best strategy. We used to have a newsletter run on that. And we realized that we had lots of losses other than short time periods when the market really comes down. And in this market, it usually comes down in 2-3 months and you can make a lot and then it goes up tremendously, right? The market. And you see a lot of losses. You only lose the money you get into, but there's also inverse ETFs. I don't think he's going to talk about actually shorting the markets, which I think is absolutely crazy because that could just whipsaw against you immediately, especially with machine trading and how quick, and you can see the shorts, the short positions in the market and how to blow out of them, which we saw with Tesla, right? And with earnings aren't that good, but Elon Musk knew exactly what to say, and that surge, and then people piled on the shorts again. And what happened to the China news? And then you look at the stock like popping tremendously. It almost went to 200. It was 140 a week ago, and I think it touched 200. And now it's pulled back to 185 or whatever with the market pulling back. But we're going to go over all that stuff. It's going to be a great interview. Definitely give it a listen. And if you want to learn more about Wall Street Unplugged Premium, including how to try it for just $1 for the first month. If you hate it, you can get rid of it. If not, it's $10 a month after. Almost everyone that subscribes, it maintains his subscription because the value that you're getting also with the Dollar Stock Club portfolio, which is a recommendation almost every week, has been on fire. And trading products, again, that's including the $10 a month. Trading products go for $100 a month in our business, $2,000, $3,000 a year. I could tell you this performance is much better probably than you'll see on any trading product because Dan and I cover the market so much and we really break it down. You get all that stuff. But it's a good service. We provide a lot more details, a lot more analysis. And we're going to provide a lot more interviews. And some of them might be here on Wall Street Unplugged Premium, Wall Street Unplugged, but that one's going to be on Wall Street Unplugged Premium, and we're going to be sharing lots and lots of actionable ideas with you. So questions, comments, I'm here for you. FrankCurzResearch.com. Thanks so much for listening. I appreciate all your support as always, and I'll see you guys tomorrow on Wall Street Unplugged Premium. Take care. Love this episode of Wall Street Unplugged? I think you'll really love Wall Street Unplugged Premium. The Wall Street Unplugged Premium is my members-only podcast where I dive even deeper into this week's events. Well, I'll do even more than tell you what's moving these markets. I'll tell you specifically what moves you can make today. So this is going to be about trading. Put big money in your pocket right away. due to the inconsistencies I see daily in the market. I'm talking about specific investment ideas I'm recommending and tracking each week that I believe will be impacted directly by everything I just talked about today. Plus, you're going to get the chance to go even further down the rabbit hole with me and my co-host, who's Daniel Creech, as we discuss which of these week's trends could turn into massive windfalls. Could the big trends that we see lurking on the horizon, also the news we're picking up from our network of insiders, which has gotten bigger and bigger thanks to you and so many people listening to this podcast in over 100 countries. And you get a chance to talk to me directly in my special Ask Me Anything Q&A session. All of that and a lot more, like premium interviews with world leaders in finance, technology, industry, and politics. This is all part of Wall Street Unplugged Premium. And becoming a member is super simple and super cheap. So head on over to WSUoffer.com to check it all out. Sign up today and you won't miss a thing. That's WSUoffer.com.
Wall Street Unplugged is produced by Curzio Research, one of the most respected financial media companies in the industry. The information presented on Wall Street Unplugged is the opinion of its host and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility.